What is synthetic replication in commodity ETFs, and how does it work? Imagine investing in a commodity like gold or oil without ever touching a bar or barrel. Instead, you relying on a clever financial trick to track its price. That trick is called synthetic replication. It is a way for exchange-traded funds to give you exposure to commodities without physically holding them. Instead of buying and storing physical assets, the ETF enters into a special agreement called a swap with a financial institution, usually an investment bank. This swap is a contract where the bank promises to pay the ETF the return of the commodity index it wants to track. The bank does this in exchange for a fee. This process is different from physical replication, where the ETF would buy actual commodities or futures contracts. Synthetic replication uses derivatives like swaps, futures, or options to mimic how the commodity's price moves. The ETF manager signs a swap agreement with the bank, which agrees to deliver the total return of the commodity index. The bank might hedge its risk by trading a basket of futures or other instruments, but the ETF itself doesn't handle these. When you buy shares in a synthetic ETF, you are essentially betting on the performance of the commodity index through the swap. You do not own the physical commodity or the futures contracts directly. This method allows investors to access markets that are hard or expensive to reach physically. It also often results in more precise tracking of the index because the swap is designed to mirror the total return exactly. Plus, it can cut down on costs related to storage and transaction fees that come with physical commodities. However, there are risks. The biggest one is counterparty risk. This means if the bank or financial institution backing the swap cannot fulfill its payment obligations, investors could lose money. To reduce this risk, ETFs usually requiring collateral from the bank, which acts as a safety net. Still, investors should check how transparent and secure the collateral arrangements are. In summary, synthetic replication in commodity exchange-traded funds offers a practical way to gain exposure to commodities without owning the physical assets. It is especially useful when physical holding is difficult or costly. But it is important to understand the potential risks involved, particularly the reliance on the financial institution that provides the swap. This approach combines efficiency with the challenge of counterparty dependence, making it a key feature to consider when choosing a commodity ETF.